Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we are going to be talking about the bearish side-by-side white lines candlestick pattern, which is a powerful yet often misunderstood continuation signal that could significantly improve your trading precision. You will discover why this tray candlestick formation, despite showing two bullish candles, actually signals a strong bearish continuation. Stay tuned as we break down the exact criteria, optimal entry points, and risk management strategies that will help you effectively trade this pattern. So let's get started. Let's begin by understanding the core structure of the bearish side-by-side white lines pattern. This formation consists of three distinct candlesticks that tell us a clear story about market sentiment and price action. So the first component you need to identify is a large bearish candle forming within an established downtrend. So this candle represents strong selling pressure and confirms that bears are in control of the market, which is this candle right here. Following this bearish candle, the market gaps down at open, but here is where it gets interesting. You observe two consecutive white or bullish candles, and these bullish candles might appear contradictory in a bearish pattern, but their placement and relationship tell a deeper story. So the key characteristic you must remember is that these two white candles have similar opening and closing prices. More importantly, they fail to close the gap created after the initial bearish candle. This failure to recover is what makes this pattern bearish. Despite the presence of bullish candles, the failure to recover is what makes this pattern bearish. So this is it right here. This is the bearish side-by-side white lines candlestick pattern, and this is the gap between the closing price of the first candle and the opening price of the second candle right here. This gap right here is what we are talking about, and the bullish candles shouldn't close this gap. The third bullish candle should not close this gap, and this signals that yes, the bearish trend is expected to continue. So this structure reveals an important market dynamics. Why buyers attempt to reverse the downtrend through these white candles or green candles in this case, their inability to close the gap confirms that selling pressure remains dominant. You can think of it as bears allowing bulls to exhaust themselves before resuming the downward movement. So let's try to spot this on the chart. Let's hop onto the charts to spot this pattern. And I think we have one right here. Okay, this is it. We have the gap, and this is the next candle's open. Now you can see the gap between the first candle and the two bullish candles, which have similar opening and closing prices. They are both doji candles, and we have the next candle, a bearish candle, which partially fills this gap, but it doesn't fill it completely. And we have the next candle, also a bearish candle, confirming the trend, which is closing below the bearish side-by-side candlestick pattern entirely, showing that the bearish trend is expected to continue. So I think let's look for another example. So we have another example right here, and this example actually price closed very close to our first candle's gap, almost filling the gap right here, almost. So you can see price actually closed very close to the first candle's close, which is, if he actually closed above it, it was gonna completely fill the gap, but it didn't exactly close above it. So this means that the bearish trend is expected to continue. And if you look at that second candle, this shows an inverted hammer, which is another bearish candlestick pattern which we can use to enter bearish trades in the market. So after that, we have this doji, and the next candle is a large bearish candle. We now have further confirmations as price closed below the low of the entire candlestick pattern. So let's look at how to trade this candlestick pattern. How can you trade with the bearish side by side candlestick pattern? A proper trading strategy requires more than just pattern recognition. You need specific entry criteria, precise risk management, and clear profit targets. So first, let's examine the ideal entry conditions. You want to confirm 3 key elements before taking any trade. So the first is you want to spot your first candle, and you want to spot the gap. You have to spot the gap and the 2 bullish candles having identical opening and closing prices. The optimal entry point comes after the formation of the second green candle. So after the formation of that second green candle, you should look for the next couple of candles closing below the second green candle, or closing below the 2 green candles. So when you have that confirmation and price closes, you should be looking to take your sell trade. In this case, you could just place your sell order right here, and your stop loss, for your risk management, your stop loss should be placed above the high of the initial bearish candle, and this placement protects your position while giving the trade enough room to breathe. The key is to keep your risk controlled. Never risk more than 1 to 2% of your trading capital on a single trade. So for your take profit targets, you could just target a 1:2 risk to reward ratio, or you can target significant support levels like this in this case, and like this one here, as you can see. So that is for the bearish side by side candlestick pattern, and that is how we could have entered on this trade by following this. But it isn't enough to just spot the pattern. You need to have an understanding of market context before placing your trades. You can't just spot the pattern and just place your trades. So you should spot a confirmation. So I like to use indicators like the moving average or the RSI. So I'm just gonna add our RSI. Let's use the RSI to confirm our trade, and using the RSI, let's try to confirm if this trade was worth taking. And you can see the RSI is very close to the overbought region, which is above 70, but it didn't exactly cross 70, above 70. So we should look for another confirmation. You can see this divergence, this bearish divergence on the RSI. You can see the RSI giving us lower highs, but the price is giving us higher highs right here, just slight. And you can see that is a divergence between price and between price and the RSI, and it's expected that price should give us a bearish push after spotting this bearish divergence on the RSI. So this was an added confluence for our trade, and you can see the moment we had that confirmation, our confirmation is the exact moment when the RSI actually is going below 50, confirming our bearish trend. So this is just for added confirmation. You can also use your moving average to confirm your trades. I'm just gonna add the moving average, simple moving average, and I'm gonna change this to the 21-day simple moving average. Now this is the 21-day, and you can see price going below the 21-day moving average right here, exactly where we had our pattern. And after that, after we had our confirmation, also you can see the strong bearish move to the downside. And this is just for added confirmations. Never use your candlestick patterns in isolation. Always trade in line with market context and also with confirmations from additional technical indicators and price action. So that is how you can use your bearish side by side white lines candlestick pattern. So for your advanced strategy, you can use multiple time frame confirmation. We are on the 4 hour right now, and you could just, after spotting your pattern, you could just go to the lower time frames to spot further continuation patterns to trade from this zone. So it's not everybody that likes to swing trade. This trade actually took about, it was from 6th September 2024 to 12th September 2024, which is about almost a week. So if you are a day trader and you spot the pattern on the higher time frame, you could just scale down to the lower time frame, like your 30 minutes or your 15 minutes. We are on the 4 hour right now, so you can just scale down to your 15 minutes and spot a better entry to take short positions. But you must do that after you've seen your confirmations and you are sure that we should be going, we should be trading lower. We should start looking for short positions. So alright traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.